Hey everyone, it's Ty coming to you from my garden here in Portland, Oregon. I've been doing a series of videos on the topic of setting up your planning model and how we would set it up and the steps we recommend you go through. And so I've got two prior videos on this that you might want to check out. One of them is talking about what we mean by a planning model and lines out what the 5 steps are that we might recommend. And then the second video that I had was going through the first of those 5 steps, which is to scrub your accounting. So I'm now getting into the third video in this series, which is identifying your KPIs. And so the prerequisite, of course, then is that you have already scrubbed your accounting. So we're assuming that you've already scrubbed your books are clean, you've got a good set of historical records. And so now we're going to actually look at how to identify key performance indicators. And so what we do in our model is we take your historical financial statements by month for the prior 12 months, and then we start looking for relationships and drivers, things that we see maybe driving different line items within that model that may be driving other line items. We also do a lot of interviewing and questioning and using industry experience to kind of look at what kinds of non-financial statement data points that you might have that would explain some of the trends that we might see over that prior 12 months. And once we have that 12 months kind of in Excel, we can then calculate and plot over the prior 12 months key performance indicators that reflect these relationships and these trends that I'm talking about. So, what exact key performance indicators you use really depends on the industry and in some cases on the exact company that you're dealing with. But there are some classic metrics for all businesses. An example would be growth rates. So, you're gonna basically look at growth rates for most businesses in most industries. So that's going to be one of the classic key performance indicators, key metrics that you're looking at trends on. Maybe you have seasonal growth and then you have seasonal decline, and that's something we'd want to identify within your prior 12 months if we can. And if we've got more data, maybe we can identify it over the last 3 years or so as well. Another classic set of metrics would be different kinds of margins. Your gross profit margin if you're selling product. The margin, the gross profit off the sales minus just the cost of goods sold on that product, or the net profit margin at the bottom of your income statement that includes all your operating expenses. These are classic metrics that we might look at. I'm going to pause here, waiting for the helicopter to get out of here.
Is that just a headphone mic?
Yeah.
Oh, okay.
Okay, so I'm going to pick it back up with, I'm going to redo the margins here. Okay, so among our classic metrics for all businesses are margins. You could be looking at a gross profit margin, which is thinking about, for example, if you sell products, your sales minus just the cost of that product before you consider any other operating expenses. If you are selling services, then you might have a gross margin, which often might be your sales minus the cost of the people performing those services before you get to other operating expenses. So those are some classic types of margins you might look at, but you also are probably going to look at your bottom line net profit margin after all expenses are in. That's also going to be a typical metric that you would be looking at. And then from there, expense ratios are just a common metric that you're going to use, right? What are my expenses as a percentage or a function of my sales? How does that how does that trend over many years? How does that trend over the last 12 months? Those are very classic kinds of metrics that are used in planning and budgeting for the future. So beyond those kind of financial metrics, the next thing that you might look at are industry-specific and non-financial metrics. So I kind of group those two things together in a weird way because really you could have industry-specific financial metrics and then you could have industry-specific non-financial metrics, right? So, you have to look at the metrics that are most important to your business. Like perhaps you have a financial metric that is the rate per hour that you charge people for your services, right? So if you're in a professional service environment, that might be a financial metric that's important. Alternatively, if you're in the same kind of professional service environment, you may have a non-financial metric like the number of hours you actually charged clients for that year or that month, as it may be, right? So your billable hours, for example, might be an important key performance metric, a key performance indicator for that is going to drive cash flow for your business, depending on how your pricing and all that is structured, right? So that'd be an example in the service environment. You know, if you're in the, let's say you're in the SaaS environment, the software as a service environment, then typically you're counting subscriptions. It might be that the number of subscriptions is an important non-financial metric. The key with non-financial metrics, they're important, and a lot of times your operators in the business, they know these non-financial metrics. They're already tracking them, or they already have a sense for them. The key with those, though, is connecting them back to the financial statements, taking that next step and saying, well, if we're counting subscriptions, then let's do some kind of reconciliation of the number of subscriptions multiplied by the rate we're charging customers to figure out how that actually reconciles to our total revenue that we have in our financial statements. Banking and contractual metrics are also important. So it may be that your company already has loans on the books. You have creditors, you have lenders, and you have a contractual requirement to have covenants. Covenants basically are metrics themselves that the bank or the lender has said, well, you've got to stay within these certain ratios. If you don't, then we're going to pull your debt. We're going to call your debt, or we're going to send you to some program where you're going to be scrutinized further if you didn't meet those metrics. And so you want to know if you're going to meet your metrics for that purpose as well. So if you're creating, if we're creating a model and we're pulling all kinds of metrics and indicators to try to create a plan, and this company is subject to covenants, then we may as well also throw in the metrics that relate to the covenants so that we can track whether we are staying on track with regard to our third-party covenants at the same time. And also in my experience, it may be that you don't actually have debt yet. You don't actually have a loan, but you're going to get one, right? Part of what reason you're doing all this planning is you're getting set up to figure out how much money you actually need to go to the next level with your business, how much money you might ask for investors versus how much money you might actually borrow. And so you're thinking about this process. So if that's the case, then we would recommend, okay, well, you don't actually have the debt, you're not under covenant yet, but let's start tracking the covenants anyway. Let's add them to our KPI stack because you're gonna be, and also the covenants, they're the same thing that a lender is gonna look at to grant you the loan in the first place. So let's see if you've been in compliance, if you would have been in compliance with a loan previously, and what you would have to do, what kind of profits and what kind of cash flow you would have to make in order to be in compliance or be able to obtain some kind of lending if that's a goal of yours. And so we'll throw those in. So that some of the classic kind of ratios in that front when we're talking about banking and contractual metrics would be things like a debt service coverage ratio or liquidity ratios. And so we'll put those into the KPI stack, into the overall model as well. So when you're choosing your KPIs, I feel compelled to kind of give you the same lecture if you saw my previous videos in terms of scrubbing your accounting, give you the same lecture that I gave before, which is don't let your KPI stack become bloated, right? Just like I said, don't let your chart of accounts and your accounting system become bloated. Don't let your KPI stack become bloated, because the truth is you can come up with almost endless numbers of different kinds of KPIs, both financial and non-financial. But the key question, the threshold question you should be asking yourself is, whatever KPI I'm including, how am I going to use that KPI for planning, right? So if it's a contractual or a debt covenant KPI or a potential debt covenant KPI, because you're going to get loans later like I was just talking about, that KPI is important and you're going to use it for planning because it's going to help tell you how much cash flow you need to be generating to qualify for a future loan. So it's going to play into what your target is, right? So that's an important KPI from that standpoint. But if you're just tracking something for the sake of it because you don't need it, you're not going to actually use it in any of your plans, then I would say that's a bloated set of KPIs, right? So don't track things just for the fun of it. Know how you're going to use it for your planning, and after you start thinking in the next step, right? So right now we've been identifying KPIs based on historical results. Our next step is going to take that KPI stack and start planning out what our KPI targets will be for the next 12 months. And so we might get into that next step and then circle back to what we're doing here and reduce our KPIs, because once we start plotting out our plan for the next 12 months, we realize that some of the KPIs we thought of here we're not actually using. And that's fine, right? I mean, you're not going to get it all perfect on the first try, and sometimes you do kind of go around in a circle to get it cleaned up and keep it nice and tight and effective and efficient. So that's my caution, is identify your KPIs, but don't suffer from KPI bloat. Okay, our next piece of this is going to be to set KPI targets. That's what we're going to address in the next video. Hey, it's beginning to rain on me here in Portland, Oregon. There's nothing new about that around here. But I'm going to go ahead and close this video. If you're enjoying the videos, if you're finding them helpful at all, please hit the subscribe button below. Tell your friends and colleagues about us, because we're really trying to build this community. And that's it for now. I will see you guys all later. Take care now. Bye.